Hello, and welcome to the Money and Banking Law Podcast with Joe Silvia, brought to you by Duane Morris, an international law firm with roughly 30 offices and 1,000 lawyers all over the world. I'm your host, Joe Silvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and financial services clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. Now, while we can't provide legal, financial, investment, or tax advice on the podcast, our goal for the Money and Banking Law podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. Thanks for joining us today. As always, if you have any questions from any of our podcast episodes, please reach out to me at jsylvia@duanemorris.com. On this episode, we're talking about the U.S. bank regulatory structure and the U.S. system for financial regulation, particularly as it relates to financial institutions. I want to talk about a couple of different things, primarily what you see on the screen here, which is our current bank regulatory structure in the United States, but also want to give a little bit of background on some of the themes of bank regulation in the United States, as well as kind of an overview of what the dual banking system in the United States really is and what it means. What you see in front of you is a broad kind of brush of how financial institutions generally are regulated in the United States. So when we're talking about bank regulation, there's a couple of themes to keep in mind. As anyone in the space knows, some of the key themes are things like safety and soundness of the banking organization or the financial institution, the products and activities that are offered by financial institutions. Those are specifically regulated in different areas that we'll talk about. There's also themes that are focused on the economic reality of our banking landscape with respect to the Federal Reserve, the discount window, and so forth. Competition issues for anybody that's ever obtained any product or service from a bank or other financial institution, you realize that there's one key theme with respect to consumers is something called disclosure, just like we have disclosure laws and Sunshine Act stuff on other areas of financial regulation and more broad-based than that even. We've got disclosures that are a heavy component of our bank regulatory structure, financial institution regulatory structure. Also have, again, with respect to consumers, consumer protection themes throughout. We also have civil rights and benefits to society, right? So wanting to make sure that the public benefits from our financial institution, primarily because we are giving banks and credit unions through the ability to offer insurance on the deposits, we're giving them some kind of federal backstop, essentially. And so we want to make sure that there are benefits to the public for that backstop. In terms of the regulatory structure you see on the screen here, we've got the Board of Governors of the Federal Reserve System. People usually just call it the Federal Reserve. There's the Office of the Comptroller of the Currency, the Federal Deposit Insurance Corporation, state banking agencies, and then the NCUA, or National Credit Union Administration. Towards the bottom, you see the Bureau of Consumer Financial Protection, or the CFPB. We'll talk about that in a few minutes. A little bit of a more new regulator, been making a lot of headlines over the last few years, but we'll get into that. So with respect to how financial institutions are regulated, once you go through the chartering process and you establish yourself as a new financial institution under any number of different structures, you need to figure out, okay, well, and you figure out very quickly during the process who your primary regulators are going to be. And yes, it's regulators as in plural, because in most cases, you're going to have more than just one regulatory agency that oversees you. When we talk about generally regulatory authority, supervisory authority, and enforcement authority, I think it's important from a linguistic perspective to understand that when I say regulatory authority, that means that that agency has the authority to write the rules that implement a statute. When I talk about supervisory authority, that's the authority for any particular agency to go in and examine the regulated institutions that they cover. And then finally, the enforcement authority is the authority to actually take action against one of these types of entities. That's particularly important as we talk a little bit more about the dichotomy of regulatory, supervisory, and enforcement authorities between the banking agencies and the CFPB in particular. With respect to the Federal Reserve, so the Federal Reserve is a primary federal regulator for bank holding companies, which are companies that own or control banks. Savings and loan holding companies, again, a company that owns or controls a savings and loan association or a savings bank. State member banks. So if you establish yourself as a state chartered banking organization, you have the ability to become a member of the Federal Reserve System. You don't have to be a member of the Federal Reserve System, but if you are a member of the Federal Reserve System, it means that your primary federal banking agency is the Federal Reserve. Federal Reserve also has primary authority over foreign banks and U.S. branches or agencies of the banks, and then edge corporations, just a creature kind of statute to be able to engage in certain activities here in the United States. The Office of the Comptroller of the Currency is the national bank regulator. That's primarily what they're thought of as. So they primarily supervise national banks, federal thrifts, and then federal branches of foreign banks. So foreign banks entering the U.S. market have choices as well with respect to whether they want to be licensed or chartered at the state level as a state branch of a foreign bank or a federally chartered branch of the foreign bank. The FDIC has primary federal supervisory authority over state chartered non-member banks and thrifts. Thrifts are really savings and loan associations, savings act or savings banks that are established under specific savings act in certain states. And so that's where their primary federal authority is somewhat narrow. Now, the FDIC is also the insurer of deposits for all these different kinds of banking organizations that we've been talking about, whether it's nationally chartered or state chartered. And we'll talk about that in a minute. State banking agencies have supervisory authority over state chartered member banks, state chartered non-member banks, state branches of foreign banks, and then state chartered credit unions, typically which within the banking agency gamut as a financial institution regulator at the state, that state chartered credit unions are covered by them. And then the National Credit Union Administration is responsible for supervising federally chartered credit unions. And then on the credit union side, the NCUA is the insurer for the deposit structure on the credit union side as well. And there's a little bit of a dynamic there we can go into at a different time. Finally, you see the Bureau of Consumer Financial Protection at the bottom here, the CFPB. So the CFPB was established after the Dodd-Frank Act, after the last great financial crisis back in 2008, 2009. So the CFPB was established as a primary federal agency to write rules and supervise and examine and enforce those rules, primarily for consumer financial services companies. And there's different definitions that are associated with that in terms of covered persons and how that works. But it's primarily those consumer financial services organizations that are not banks or not community banks as we think of them, which traditionally has been banks under $10 billion in assets. They do have primary authority over primary supervisory authority and regulatory authority over large banking organizations with respect to what are called the enumerated consumer financial laws. So the way to kind of think about how this works now is to say, okay, with the CFPB and the Dodd-Frank Act, we have established a new agency. And the priority for this agency is the rule that they have won the regulatory or the rulemaking authority over what are called the enumerated consumer laws. These laws are the Electronic Funds Transfer Act, Equal Credit Opportunity Act, Fair Credit Reporting Act, Truth in Lending Act, the Real Estate Settlement Procedures Act, the Home Mortgage Disclosure Act, the Safe Mortgage Licensing Act, and others. And what this means is, from a regulatory perspective, the CFPB has the primary authority to write the rules that implement those statutes. There's a number of other statutes that are included in the definition, but those are the biggest ones. And it used to be the case that folks at the Federal Reserve primarily were the ones that wrote the rules with respect to, for example, truth in lending and to implement the Truth in Lending Act. So what Dodd-Frank did was take certain rule writing authority away from folks like the Board of Governors and put it into this new entity, the CFPB. With respect to the supervisory authority, again, the authority to go examine an institution, the CFPB's supervisory authority is this aspect of Dodd-Frank creates a dichotomy in who supervises and enforces the laws and the regulations depending on the different types of institutions. Okay, so what this means is that from a supervisory and enforcement perspective, the Federal Reserve and the OCC, FDIC, and so forth, they have the primary supervisory and enforcement authority for consumer financial laws for those banking organizations under $10 billion in assets. For large banking organizations, again, over $10 billion in assets, those institutions will be primarily supervised and the enumerated consumer laws will be enforced against those institutions primarily by the CFPB. So it creates this dichotomy depending on how large the banking organization itself is. Outside of banking organizations, the supervisory authority of the CFPB extends to non-depository covered persons, a defined term, and then affiliates and service providers of certain covered persons or of large depository institutions, so large banking organizations. There's also some authority over those community banks under 10 billion, but it's more of a backup authority behind the other primary federal regulators. The enforcement authority of the CFPB tracks the supervisory authority in terms of the institutions that are subject to that authority at the CFPB. They've got really broad enforcement authority, includes the ability to rescind contracts, refund money, return property. They have restitution authority, damages, disgorgement of profits, CMPs, and so on. So really, really broad authority of the CFPB. And again, this was created in the wake of the great financial crisis. So a lot of consumers got harmed, a lot of things didn't go as planned in terms of consumer protection. And so the CFPB was created to remedy that scenario. So again, this is kind of a background on where we are today with respect to the bank regulatory structure. The CFPB right now is not very active. There's been a lot of talk about whether or not it's a constitutional agency, and I'm not going to get into all of that. But there's been a lot of discussion around what that means going forward because the agency just doesn't have a lot of people there anymore, a lot of work going on. We'll see what happens in the future as administrations change and perspectives may change in the future. So more to come on that. The final note I have here is the FFIEC, the Federal Financial Institutions Examination Council. It's really a council of all these agencies at the federal level. They provide a number of different data tools and uh, guidance documents that are on their website. That's where you can find the very large and expanding BSA AML exam manual that these different institutions will use to examine or supervise and examine and enforce the rules there for their particular regulated entities. But I really wanted to just give a background because I realized that we started jumping into different areas of banking law and financial services law. And this is one area that I teach, and it's a really kind of a basic level set for folks to understand from the outset. If we're talking about a national bank, okay, well, then we need to be talking specifically, at least initially, about the statutes and regulations that apply with respect to how the OCC supervises a national bank. If we have a state chartered non-member bank, then at the federal level, we're talking about the FDIC. So what you can see here, as you can imagine, is the way that banks generally get structured is that you'll have at least one federal regulatory agency with authority over you. You may have more than that. You have state banking agencies if you're a state chartered institution, but you're also going to have a federal overlay from either the FDIC or the Federal Reserve. The FDIC has a piece of kind of regulatory and some supervisory authority generally over all banks in the United States because they're the provider of the insurance. Similarly, the NCUA for federally chartered credit unions and some state chartered but federally insured credit unions as well. So, with that, I'll leave this for your review. And if you have any questions, please let me know. I'll stop there for the day, but I wanted to give kind of a basic background on some of the bank regulatory structure we have in the United States, because as a young lawyer, it is really important to understand first what kind of institution may you be dealing with as a client or potential client? And then how is that institution actually regulated? By whom is that institution regulated? And how are they regulated? Whether it's more of the prudential perspective, which is the safety and soundness that we see from the federal banking agencies. It may be a little bit more focused on particular products and services, especially in the consumer segment. So you look to the CFPB. But that dichotomy of the supervisory and enforcement authority is important to take note of because it does trip people up initially when we have young lawyers or young banking lawyers coming out. They're trying to really understand how this dual banking system works, where you can have federally chartered institutions and state chartered institutions at the same time. Sometimes they're regulated cross ways, and so again, something to keep in mind. So we'll stop there for today. If you have any questions about this or any of our other episodes, please feel free to email me. Let me know, jsylvia@dwaynemorris.com. Please feel free to reach out anytime. Please like and subscribe wherever you get your podcasts. Let me know if there's other particular questions that are coming up in your practice or with respect to your institution that we can be helpful with. If there's something that's broad-based, then we'll talk about it on the podcast. And with that, I'll sign off and wish everybody a great day. Thank you so much.